Welcome back, you legends. I'm Dr. Kala. Let's get right into this video. So the stock market today is actually down just about the same, about 1% on all three major indices. Taking a look at the different sectors, energy surprisingly and basic materials are lagging today. So the inflationary sectors are now lagging, but not for the reasons that you're thinking about. What actually happened was that Germany is actually already ahead of schedule in terms of filling its strategic gas stores. In fact, the country is expected to reach its October 85% target by September 1st, so in a couple of days. This led to a 21% decline in European gas prices after a massive surge in prices just a few weeks ago. On the inflation front, unfortunately, news continues to be grim for Europeans. Now Goldman Sachs, and we all know Goldman Sachs are the best of all the Sachs, whatever the heck that means. So Goldman Sachs warns UK inflation could hit 22% in January if the United Kingdom lifts its price caps on utilities and energy prices, and German inflation has already hit 50-year highs. In fact, inflation in August topped inflation in July, but with energy prices going down this week, it looks like that German inflation will probably begin to top, just like we've seen in the US. Now, this has had substantial ramifications for energy prices, oil and gas. In fact, oil is down 5.5% on the day just today, completely reversing that bullish crossover that we had yesterday. On the weekly chart, on the other hand, guys, we're still consolidating and momentum seems to be flattening on the weekly chart and attempting to start moving back up. Personally, I'll be looking at the $95 level on UK oil, on Brent crude oil. If we break that level, guys, this week, and then we have a lower low next week, in my opinion, that would confirm a bear flag on energy. On oil. Now, oil tends to be very sensitive to news. It's a news-driven commodity, which makes it extremely unpredictable and difficult to trade, especially if we go simply by the technicals. Because back over here, guys, the technicals looked amazing, right? We had this beautiful divergence where momentum was actually putting in higher lows and price action was putting in lower lows, creating a bullish divergence. That divergence led to this rally to the upside. We had a significant close of the 50-period daily moving average, and that was very bullish for oil. Unfortunately, that completely reversed to the downside just today. So again, we could be looking at two possible scenarios. The first scenario is a cup and handle formation. We will have to maintain these current levels for this cup and handle formation to be confirmed. A break below the 20-day moving average at around 97 would be very bearish. And again, on the weekly chart, a break below last week's low at 96 and a consecutive low next week, unfortunately, would end the bullish developments in oil. Now, I continue to be bullish on oil and on energy in general. I think energy will continue to outperform for the rest of the year, especially as yields rise. Now, let's go back to the S&P 500 stock market map. We're seeing red all over the place, but we're also seeing concentrations of selling into energy, driven by that news from Germany. We also have some big cap tech companies like Apple and like the semiconductors, including Nvidia and Tesla, seeing some significant selling today. Let's take a look at the daily chart for the S&P 500. We're continuing to see an acceleration of the selling to the downside. Momentum is accelerating, right? We're seeing bigger and bigger bars on the PPO. To the downside, my target remains at $390. The weekly expected move is still sitting at $394. I expect us to actually break that weekly expected move and go to $390. From there, I'll be looking for possibilities for bounces to the upside. Now, in the trading group today, we actually were looking for opportunities to go short on the S&P and the NASDAQ. Unfortunately, all of the selling occurred really in the first hour of trading, After that, really, we've just been moving flat, right? And again, this is very typical of bear markets and a sharp rise in volatility. We see very sharp sell-offs and volatility and some choppiness, really all of the above. Going back to the daily chart, guys, we're continuing to see significant down volume on these really big red candles. So obvious distribution days where hedges are probably dumping a lot of positions. And on the 1 hour chart, I did spot this downward wedge. We're seeing some flattening of the PPO, which is bullish. We have this very interesting double dip with a touch of the upper edge of this descending wedge. Now, the stock market failed to break out of this descending wedge. So more likely than not, tomorrow we'll see either a quick break to the upside at the open, or a simply gap up on the day, and then we'll see what the market does from there. Alternatively, guys, this could still be a bear flag, and so again, I'll be watching for a break below the $396 to take out these lows and test the $390 level. We don't have much news coming out tomorrow on Wednesday, but we do have a lot of economic events coming up Thursday and Friday. So we could possibly see the stock market just try and chill out tomorrow and see the significant moves either on Thursday or on Friday or both. Taking a look at the weekly chart, interestingly, guys, we've already seen nearly half of the trading volume of last week's trading volume coming in the first couple of days. And this looks like one ugly tombstone formation. And I could easily see the weekly candle closing near the $390 level, where I expect the market to try and find somewhat of a base and attempt to rally again. And we'll be watching for a failure of that rally and a continuation to the downside. Now, all indicators continue to be bearish, guys. The VIX continues to see strength. Right, we're now seeing a bull flag on the VIX. And the thing with the VIX, guys, is that when you see a breakout of the VIX, we tend to see massive moves to the upside very quickly, one right after the other. Just like what happened in April, just like what happened in February and in January, and right here in November. And we're seeing that on the price action intraday, right? We're not seeing the market trying to retest the 20-period moving average or the 50-period moving average. So the market is not giving us any entries. It's just selling and selling and selling. Now, taking a look at the Qs, we had a major break of this support line. Unfortunately, this is very bearish for the triple Qs, for the NASDAQ. And in my opinion, this will lead to a significant underperformance by the NASDAQ versus the S&P, and will likely lead to a retest of the June lows. The spread between the fast-moving and the slow-moving moving averages on the PPO are widening. We're seeing bigger and bigger candles. Volatility continues to be high, and trading volume continues to be high. We've now seen 3 major distribution days, and we are very likely to see a 4th day this week, right? Because it is very common to see distribution days come in 1, 2, 3, 4s, and 1, 2, 3, 4 distribution days. Same thing here, guys, 1, 2, 3, 4 distribution days. So it is very common to see the sell-off take place in a concentrated action in about 4 to 5 days, typically 4 days. We had the same thing right here, guys, 1, 2, 3, 4 days, and on the 5th we rallied. Again, same thing here, guys, 1, 2, 3, 4 days, and we rallied on the 5th. So I'm waiting for that 4th distribution day, and I'm expecting the 5th day to be a gap down day where we gap down and move to the upside, and that will likely take place right around the $290 level on the triple Qs, and right around the $390 level for the S&P. That could happen as quickly as tomorrow or Thursday or Friday. Let's take a look at the HYG, our trusty HYG high yield bonds. Now we take a look at these to spot divergences, guys, because divergences like the ones that we spotted right over here marked every single top in the S&P 500. In fact, let me show you where those occurred. Look at this, mark the top, mark the top, mark the top, and mark the top. In fact, if I show you the weekly chart, Look at this. Every single time we marked the top and had a significant sell-off. And it also works to mark bottoms. So now I'm trying to find any divergences that would indicate a bottom, and I'm not seeing any divergences. So we're still seeing significant selling in the HYG, and that unfortunately will lead to more selling in the S&P. Now let's take a look at yields. We have the 10-year yield right over here. The 10-year yield is actually flattening, which is very interesting. We're still holding this bull flag. I am still waiting for a break to the upside. The more time passes, the more time we spend at this level, the more violent the move that will come afterwards will be, right? Either to the upside or to the downside. I'm still expecting a head and shoulders top, and so it looks like the top could come this week. Taking a look at the 2-year yields, 2-year yields are actually putting in new highs, right? Very slowly, but we're putting in new highs on the 2-year yield. And the 2-year yield, guys, is more sensitive to Fed funds rate, to Fed action. The longer term yields, like the 10-year yields, are more sensitive to inflation. And the TLT, the much longer term bonds, these are 30-year treasuries. We're seeing a possible bottoming formation on the TLT. I would still need to see a bullish crossover on the PPO because this could still be just a bear flag that takes us even lower. Now, if the TLT sees a bullish crossover and we start to move back up to the upside, this will allow a lot of the tech stocks to actually breathe some and start to move to the upside as well, because a lot of the tech stocks are very high PE ratio stocks, so they're very expensive, and expensive stocks in terms of PE ratios are very sensitive to long-term yields, and a flow into long-term bonds crushes long-term yields and allows these stocks to breathe. Let's take a look at gold. Gold continues to see pressure to the downside as the dollar index continues to hold this bull flag pattern. Now, I do like gold as a long-term hold, just as a hedge against inflation and a slowing economy. And we're approaching that key $156 level that I'm looking at, right? I'm waiting for a retest of this low again, and for us to form a bullish divergence, right? A higher low on the PPO and a slightly lower low on the price action. That, in my opinion, will be the absolute perfect entry to go long and hold gold for years to come. Again, the dollar index continues to hold this bull flag pattern. I'm not seeing a break to the upside or to the downside. I'm still waiting for a break and a close above the 109.5 level right around here. If we see that happening, guys, that will put a lot of pressure on equities and will very likely lead to another leg of selling. Now, I've been watching the dollar index for a few days now, waiting for a break to the upside or to the downside. Price has continued to tighten. A break to either direction will lead to a massive move either to the upside or to the downside on both the dollar index and the stock market. In fact, that's why I opened a strangle on the triple Qs that will make a lot of money if the triple Qs see a counter trend rally or a continuation of the sell-off. In either direction, the only way this trade loses money is if that the NASDAQ stays flat tomorrow, which is a real possibility, which is why I opened a tiny position. Again, guys, if you're interested in following my trades, I do post every single trade and investment in real time in the trading community. I also go through mentoring, lessons, strategies, and trade ideas, all of that good stuff. It's $20 a month if you want to support me or follow my trading activity. That's the best way you can do that. Let's take a look at Apple. Apple continues to disappoint. It continues to disappoint. Look at that again, 1.5%. Again, Apple is underperforming the S&P. I've been warning about this since we saw this top back here in mid-August. What worried me the most was this absolute insane bear market rally in Apple. These kinds of insane bear market rallies happened in 2008 and happened in the 2000 bear market. So they're very typical, and unfortunately after these bear market rallies end, Apple tends to significantly underperform the market. In terms of a price target, I'm watching the $150 level right around here for Apple to go all the way down to 150, and then I'll be watching for some structure in Apple, either for a counter trend rally or for a continuation to the downside. Now let's take a look at Tesla. Tesla continues to see weakness, again underperforming the rest of the market. Tesla looks to me like it wants to go all the way down to $250. I don't see really any meaningful support all the way down to $250. I'm not trading options on Tesla because options are too expensive in my opinion. I'd rather trade options on something like Apple or the S&P or the NASDAQ versus Tesla, simply because the options are too expensive. They have a lot of implied volatility baked in, and so risk to reward is not that great on Tesla, unfortunately. But if you're looking for a long position, I would be looking for some structure right around $250. Let's take a look at Exxon Mobil. We had this really gap and crap move to the downside, right? We gapped to the downside and continue to sell. This is a very bearish development, but you have to remember that it was news driven and we're still in a bullish context, right? The PPO is still pointing up. We have this little nudge to the downside, but as long as we do not see a bearish crossover, and as long as we hold above the 20-day moving average and above this prior resistance line, now likely turned support line, as long as we hold above these levels, the long-term trend in Exxon Mobil will continue to be bullish. But again, it all depends on what happens with oil. Again, if we see a cup and handle formation, something like this, and a continuation to the upside, or a break below the 20-day moving average, which in my opinion would be bearish. Let's take a look at fear and greed. I just want to point out the put to call ratio. We had this bull flag in the put to call ratio, and we've put in a new high today in the put to call ratio. This is a bearish development. It indicates that more selling is coming. Market volatility continues to be high, continues to hold above the 50-day moving average. Nothing good happens for stocks when volatility is above the 50-day moving average. Safe haven demand is skyrocketing, right? Bonds are now outperforming the S&P 500. And again, junk bond demand is collapsing. We're seeing yield spreads widen between the investment grade bonds and junk bonds. And that happens when people dump junk bonds and buy investment grade bonds instead, which are considered a safer investment. Let's take a look at what we have coming up this week. Wednesday, tomorrow, nothing really important in my opinion, nothing major, but we do have Loretta Mester speaking. She's one of the most hawkish FOMC members. We also have Raphael Bostic speaking. He was a dovish member turned hawkish, so watch out for what they have to say. Thursday, guys, we have a lot of job numbers coming out, as well as Friday, but most importantly, the unemployment rate, which everyone is going to be watching on Friday. A bad unemployment number will be actually bullish for stocks, and a good number is actually bearish for stocks, because the Fed is now targeting unemployment rate to move up to 5%. And if unemployment continues to be low, and if unemployment in fact declines, for example, that would be very bearish, because that would indicate that the Fed would need to raise rates even higher. So keep an eye out on the unemployment rate and keep an eye out on jobless claims. Again, jobless claims, if we see a surprise to the downside, that would be bearish for stocks. That's really all I have for you today, guys. Thank you so much for watching, supporting, and I'll catch you in the next one. Bye-bye.
Oh, wow.